Okay, so picture this. You're in 2008, right in the thick of it, and the world feels like it's just crashing down around you.
Oh, yeah.
Your portfolio is plummeting. Every fiber of your being is screaming, sell, sell, sell.
Oh, I remember that feeling.
But what if the real winning move, the one that like only the most disciplined investors make, what if it was to do nothing?
To just sit there.
To just sit there?
Yeah.
What if the best move was to actually buy more?
That feeling right there, that urge to just sell everything, that's what we're diving into today.
Exactly.
It's how fear and greed influence, I think, every investment decision we make.
Yeah.
And very often, they lead us astray.
I think we've all been there, right? Like you felt that pull
Absolutely.
to act impulsively.
Yeah.
And you're here with us because you're either looking to improve your investing or you're just fascinated by this whole psychology of it.
Absolutely.
Either way, we've got you covered.
Yeah, we've got research articles, real-world examples. We're going to go from the 2008 crisis to the GameStop saga.
Ooh, yeah.
We might even share some of our own investing mishaps along the way.
Oh, I'm sure we've got a few of those.
We're not just going to summarize these sources, though. We're going for that aha moment, that real nugget of insight that helps you understand what makes the markets tick.
Okay, so let's start with the emotion that makes our palms sweat, our stomachs churn.
Fear.
Fear.
Yeah.
When the market takes a dive, it's like our brains go into survival mode.
It's so fascinating how biology plays into this,
Yeah.
because our brains are wired to avoid danger. And that's where the amygdala comes in.
Okay.
It's this part of our brain that triggers the fight or flight response.
Right.
And when uncertainty spikes, like in a volatile market, that just sends our perception of risk through the roof.
It's no wonder we just make these impulsive decisions like panic selling at the worst possible time.
Exactly. And it's not just about individual psychology either,
Right.
There's this powerful influence of the herd mentality.
Oh, yeah.
When everybody around us is selling, we feel this immense pressure to do the same, even if it goes against our long-term goals.
Yeah.
And this was a huge factor in the 2008 crisis, where mass withdrawals actually worsened the whole situation.
It's like a financial stampede.
It is.
Everyone's rushing for the exit and logic goes out the window.
Yeah, that's a great analogy.
Thanks.
And one of the most compelling insights from the research is this concept of loss aversion.
Okay.
So humans feel the pain of a loss about twice as strongly as the pleasure of an equal gain.
Wow.
So even if rationally you understand a market dip is temporary,
Right.
emotionally it can feel like the end of the world.
I wonder if our caveman ancestors ever felt that way about a dwindling food supply.
I bet they did.
Yeah.
It's so fascinating how these ancient survival mechanisms are still influencing our behavior in the modern world.
It's true. Okay, but let's shift gears a little bit.
Okay.
Let's talk about the flip side of that, the thing that makes our eyes light up with dollar signs.
Greed.
Greed. It's the force that makes us chase, those sky-high returns without always doing our homework.
And greed is often amplified by FOMO in today's world.
Oh, totally.
The fear of missing out. Think about those classic examples like the dot-com bubble, where people were pouring money into anything with a .com in the name.
Oh, yeah.
Or the GameStop frenzy, where social media hype sent that stock price soaring.
Yeah, it's like logic takes a back seat and we all become like these dopamine-seeking machines chasing that next big win.
It's really remarkable how brain chemistry plays a role there, because when we anticipate a reward, our brains release dopamine,
Right.
which is the same neurotransmitter involved in pleasure and addiction.
Oh, wow.
And that dopamine rush can be so powerful it overrides our rational caution
Yeah.
and leads us to make these impulsive, risky decisions.
And sometimes those decisions, they feel so right in the moment,
They do.
even though we know they're probably not good for our long-term financial health.
Yeah.
Have you ever fallen into that trap?
Oh, yeah, absolutely.
Okay.
I think we all have.
That's why I'm so fascinated by all this. It's like we're trying to outsmart our own brains.
You hit the nail on the head. We're not just battling market forces. We're battling our own deeply ingrained instincts.
Yeah.
And understanding those instincts, that's the first step towards making more informed and rational decisions.
So it's not about becoming like an emotionless robot.
No.
It's about developing that awareness and the discipline
Exactly.
to make choices that align with our goals,
Yes.
not just our impulses.
Exactly. We'll dive deeper into those strategies a bit later.
Okay.
But first, there's another layer to this fear and greed dynamic that we need to unpack.
Okay.
And it's particularly relevant to today's always-on digital world. You ready for this?
Hit me with it. I'm so intrigued.
Okay. It has to do with how technology and social media are essentially pouring gasoline on the fire of fear and greed.
Oh.
Remember way back when you had to wait for the evening news or the morning paper to get your market update?
Yeah, I kind of do.
Now it's instant. It's in our pockets, and everyone's screaming about the latest crash or surge in whatever.
It's like a 247 financial news cycle.
It is.
Yeah.
And it's impossible to escape that noise.
Mm-hmm.
And this constant barrage of information,
Right. Yeah.
which often is unverified and emotionally charged,
Totally.
it can seriously overwhelm our ability to think clearly and make rational decisions.
Yeah.
And this is especially impactful for younger generations who are practically glued to their devices.
Think about GameStop again.
Oh, yeah.
That wasn't just a bunch of people making bad calls. It was like a collective frenzy fueled by social media.
It was.
It was like a perfect storm of FOMO and the illusion of easy money.
The GameStop saga is such a fascinating case study in how technology can create this feedback loop
Yeah.
that amplifies both fear and greed.
Hmm.
It's like the entire market becomes this giant emotional roller coaster, and it's really hard to get off, even when, it might be heading for a crash.
So it's not just our own internal biases.
No.
We're fighting this external pressure from the digital world.
Exactly. It's like we're all wired into this collective emotional circuit, and that brings us to a really important concept in understanding how markets actually work.
Ooh.
Behavioral finance.
Okay, let's unpack that. I'm ready to get a little nerdy here.
Okay, so traditional finance theory operates on the assumption that investors are these rational actors,
Right.
making decisions based purely on data.
Yeah.
But behavioral finance flips that idea on its head.
Okay.
It acknowledges that we're human. We're
Yeah.
driven by emotions.
Yes.
And those emotions absolutely influence our financial choices.
Which explains why markets often behave in ways that just defy logic.
Precisely. Behavioral finance helps us understand things like market bubbles, crashes, and all those investment decisions that seem completely irrational in hindsight.
Right.
Remember all those cognitive biases we mentioned earlier?
Yeah.
Loss aversion, overconfidence, confirmation bias. They all fall under this umbrella of behavioral finance.
So it's not about being good or bad at investing. It's recognizing that we're all wired with these tendencies that can trip us up.
You got it.
It's almost like we're fighting against our own brains.
That's an excellent way to put it. And the more we understand those tendencies, the better equipped we are to overcome them.
Okay, but before we get to the solutions, let's zoom out for a second.
Okay.
We've talked about fear and greed and isolation, but what happens when they start interacting with each other on a larger scale?
Enter market cycles.
Oh.
This is where we see fear and greed playing out on a grand stage,
Mm-hmm.
fueling those booms and busts that make the financial world both exhilarating and terrifying.
Wait, so you're saying that like our collective emotions are actually driving these massive market swings?
To a large degree, yes.
Wow.
Fear leads to bear markets where everyone's selling prices are plummeting.
Right.
It feels like the guy is falling.
Yeah.
Then, as things stabilize and optimism returns, greed takes over, prices start to rise.
Mm-hmm.
People jump in, we get a bull market.
Right.
But eventually, that greed gets out of control, leads to overvaluation. And
yeah.
boom, another crash.
It's a cycle.
It's a cycle as old as time.
It's like a financial version of Newton's third law.
I like that.
For every action, there's an equal and opposite reaction.
Exactly. And just like with physics, these market cycles are driven by these opposing forces.
Mm-hmm.
In this case, those forces are fear and greed.
Okay, but isn't it obvious when we're in one of these cycles? I mean, it seems pretty clear in hindsight.
Yeah.
But what about when we're actually living through it?
That's the tricky part. You see, while it's easy to see, these cycles, in retrospect, recognizing them in real time is incredibly difficult
Yeah.
because our emotions, they cloud our judgment,
Totally.
making us think this time it's different,
Oh, yeah.
whether it's irrational exuberance during a boom or excessive pessimism during a bust.
Right. So we're all susceptible to these emotional swings, and they can have a huge impact on our investment decisions and on the markets as a whole.
They do.
But the million-dollar question is, what can we actually do about it?
That's where we shift from understanding the problem to developing strategies for success.
Okay.
And luckily, there's some very practical steps we can take to tame, our inner beast, those primal urges to either run and hide or chase every shiny object we see.
Give us the tools we need to navigate this minefield.
Well, first things first, we need to acknowledge that we can't completely eliminate fear and greed.
Okay.
They're part of what makes us human.
So it's not about becoming some kind of Spock-like emotionless investor.
Exactly. It's about developing emotional discipline.
Okay.
Think of it like training a muscle. The more we practice making rational decisions, the better we become at resisting those knee-jerk reactions.
So it's about building up our mental fortitude so we can stay calm and focused when the market throws us a curveball.
Precisely. And one of the most effective strategies for doing that is creating a plan before you even think about investing.
Yeah, having a plan takes the emotion out of it.
Instead of reacting impulsively to every fluctuation, you've got a roadmap to follow.
Yeah, so it's like setting rules for ourselves
Exactly.
that we stick to no matter what.
That's the idea. A systematic approach.
Right.
And a well-defined plan should include things like, your financial goals,
Yeah,
your risk tolerance,
right.
your entry and exit points for each investment.
Mm.
That way, when the market inevitably gets bumpy,
Yeah.
you'll know exactly what to do.
Yeah, that makes a lot of sense. It's like having an anchor when the storm hits.
Exactly. Now,
Ah.
another powerful tool for managing fear and greed is dollar cost averaging.
Okay.
This involves investing a fixed amount of money at regular intervals, regardless of market fluctuations.
So instead of trying to time the market perfectly, which is impossible,
Yeah.
you're basically spreading out your investment over time.
You get it. Dollar cost averaging removes the emotion from that timing decision.
Mm.
And over the long run, it can actually help you buy more shares when prices are low and fewer shares when prices are high, which can potentially boost your returns.
That's pretty clever. You're taking advantage of those ups and downs without having to stress about it.
Exactly.
Yeah.
And speaking of taking advantage of market fluctuations, that brings us to diversification.
Okay.
Instead of putting all your eggs in one basket,
Yeah, don't do that.
you spread your investments across different asset classes.
So if one area takes a hit, the others can kind of cushion the blow.
Precisely, diversification is like a financial safety net.
I like that.
It helps to minimize losses when one particular sector or industry goes through a rough patch.
Right.
And it also helps smooth out those emotional highs and lows because you're not overly exposed to any one investment.
This is starting to sound like a well-balanced and emotionally stable portfolio.
It is. And you know what's interesting about all these strategies?
What's that?
They not only help us manage our emotions, but they also happen to be aligned with the principles of sound long-term investing.
So we're not just talking about psychological tricks here. We're talking about fundamental investment principles that have stood the test of time.
Exactly. And that's why developing emotional discipline is so crucial for success.
Yeah.
It's not just about feeling better, it's about making better decisions.
Okay. I'm convinced we need to get a grip on our emotions. But let's be honest. Even with a plan, dollar cost averaging, and a diversified portfolio, we're still going to feel that urge to panic or chase a hot stock.
Yeah.
So how do we actually deal with those moments when those feelings creep in?
That's where mindset comes in.
Okay.
It's not just the external strategies we use, it's about cultivating the right internal attitude.
So we need to train our brains to be more resilient.
Exactly.
Ugh.
One of the most powerful mindset shifts is reframing losses.
Okay.
Instead of viewing them as failures, think of them as learning experiences,
Ah.
opportunities to refine your strategy and make better decisions.
Yeah, I can see how that would be helpful. It takes the sting out of it.
Precisely. And another key mindset principle is patience.
Okay.
Investing is a marathon, not a sprint. It's about the long game,
Right.
not quick wins or trying to time the market perfectly.
So resist that urge to constantly check our portfolios.
Exactly, because checking too often can actually amplify your emotional reactions.
Yeah.
When you see a dip, it's easy to panic and make an impulsive decision that you later regret.
Right.
But if you're focused on the long term, you can ride out those short-term fluctuations.
Right.
Let your investments grow steadily over time.
It's like the difference between sprinting and long-distance running. Sprinting is all bursts of energy,
Birth reactions.
but long distance is about pacing yourself.
Exactly. And just like a marathon runner needs to train their body, a long-term investor needs to train their mind.
So we're not just managing our money, we're managing our minds.
Precisely. And if you find yourself struggling to do this on your own, there's no shame in seeking help.
Oh, yeah.
A financial advisor can provide objective guidance, help you create a plan, and act as an emotional buffer.
That's a good point sometimes. That outside perspective can really make a difference.
It can. And you know what's really interesting about this whole conversation?
Well,
We've been talking about fear and greed as these obstacles to overcome.
right.
But what if we could use them to our advantage?
Wait, you're saying we can harness the power of fear and greed?
It might sound paradoxical,
Yeah, it does.
but it's absolutely possible. Think of it like this.
Okay.
Fear and greed are powerful currents in the ocean.
Okay.
They can either toss you around helplessly,
Right.
or you can learn to surf those waves
Oh, I like that.
and use them to propel you forward.
How do we become master emotional surfers?
Remember that famous Warren Buffett quote?
I think so.
Be fearful when others are greedy and greedy when others are fearful.
Yeah.
That's the essence of contrarian investing.
So going against the grain, doing the opposite of what everyone else is doing.
In a nutshell, yes, when the market is in a frenzy and everyone's buying,
Mm-hmm.
that's when you need to be cautious.
Okay.
When fear is gripping the market and everyone's selling,
Mm-hmm.
that might be the perfect time to buy.
That sounds risky, though, going against the herd.
It can be. But remember, fear and greed distort everyone's perception.
Yeah.
The key is to step back, assess the situation rationally,
Mm-hmm.
and make decisions based on your own analysis, not the emotions of the crowd.
So being a critical thinker, not a blind follower.
Exactly. Contrarian investing requires a strong stomach and a clear head,
Right.
but it also has the potential to generate significant returns
Yeah.
because you're buying low and selling high.
Okay. I'm starting to see how this works. But how do we know when to be fearful and when to be greedy?
There's no magic formula,
Okay.
but there are some indicators that can help you spot, overheated markets and undervalued markets.
Like what?
Well, during a period of greed, you might see things like rapidly rising price-to-earnings ratios,
Okay.
high levels of margin debt, lots of media hype.
Oh, yeah.
And conversely, during a fear-driven downturn, you might see low valuations,
Okay.
pessimistic sentiment,
Mm.
a general aversion to risk.
So looking for those extremes.
Exactly. And remember, this is where your plan and your emotional discipline come into play.
Right.
Having a predetermined strategy will help you to avoid getting swept up in the hype
Yeah.
or the panic
Right.
and make decisions based on logic, not emotion.
This is all starting to make sense, but let's get practical.
Okay.
What are some hacks we can use to outsmart our biases?
I'm glad you asked. There are a few effective techniques.
Okay.
One of the simplest is using a checklist.
A checklist like pilots use before takeoff.
Exactly. Before making any decision, force yourself to pause.
Mm-hmm.
Go through a series of questions.
What?
Ask yourself, am I reacting emotionally or rationally?
Oh, okay.
Does this align with my goals and risk tolerance?
Yeah.
Have I done my research?
Yeah.
Considered the risks?
Yeah.
Considered alternative investments?
Oh, okay.
Having this checklist in place can help you slow down, take a breath, and avoid making impulsive decisions.
It's like a safety net for our brains.
Precisely. Another helpful technique is tracking your decisions. Keep a journal of your investments. Note your rationale for buying or selling,
Mm-hmm.
your emotional state at the time,
Right.
and the outcome.
So we're becoming scientists of our own behavior.
Exactly. By analyzing your past decisions, you can identify patterns
Mm-hmm.
and spot those moments when fear or greed might have clouded your judgment.
Yeah.
This can be incredibly valuable.
It's like turning our investing journey into a continuous learning experience.
That's a great way to put it. And you know what's really cool about these behavioral hacks?
What?
They not only make us better investors, but they make us more self-aware.
So improving our financial well-being and our overall decision-making.
Exactly. Win-win.
Nice. But before we wrap up this section,
Yep.
I want to mention one more strategy that can be powerful,
Okay.
especially for those who struggle with emotional investing.
What's that?
What's the secret weapon?
Automation.
Okay.
Setting up automatic contributions to a diversified portfolio can take the emotion out of the equation.
It's like putting our investments on autopilot.
Precisely, you're removing your impulsive self from the equation,
Right.
letting a system handle it based on a predetermined strategy.
That sounds peaceful.
It can be, especially if you're prone to emotional investing.
Yeah.
It can help you stay disciplined and avoid those costly knee-jerk reactions
Mm-hmm.
and build wealth over time.
This has been so insightful. I'm starting to feel a lot more confident.
That's great to hear.
Yeah.
But before we move on to the final part of our deep dive,
Okay.
there's one more element we need to address that's often overlooked.
Oh, I'm curious. What is it? You've got me on the edge of my seat. What is it?
It's the human element.
Okay.
Intuition, that gut feeling that tells us when something's right or wrong.
Ah, intuition. Some people swear by it. Others think it's just bias.
It definitely sparks debate. Some think it's our subconscious processing information,
Right.
picking up on patterns we're not aware of.
Mm-hmm.
Others see it as a more like mystical sixth sense.
So where do you stand on this? Should we trust our gut when it comes to investing?
I think intuition can be valuable, but we've got to use it wisely.
Okay.
It's not about making impulsive decisions based on a hunch.
Right.
It's about integrating your intuition with rational analysis.
So intuition is the co-pilot, not the pilot.
That's a great way to put it.
Yeah.
Your rational mind is the pilot planning the flight,
Yeah.
navigating the course. Intuition is the co-pilot giving you extra insights,
Yeah.
maybe warning you about turbulence.
I like that it makes me think of those times you get a bad feeling about an investment, even if the numbers look good.
Exactly. Those are the times to pay attention. Don't ignore those feelings,
Right.
but don't let them completely override your analysis either.
So finding that balance.
Precisely. And the key to that balance is self-awareness and experience.
Yeah, okay.
The more we understand our own patterns and the more we learn about the market,
Right.
the better we get at separating genuine intuition from those biases.
So it's a skill you can develop over time.
Absolutely. Think of it like any skill, the more you practice, the better you get.
Right.
By studying market history,
Yeah.
analyzing successful investors, constantly learning, you can really sharpen that intuition.
It's like training our subconscious to be better investors.
That's a great way to put it. And what's really fascinating is intuition often operates below conscious awareness.
So we might not even realize we're using it.
Exactly. Sometimes an investment idea just pops into your head.
Right.
Or you get this urge to buy or sell something. And it feels random, but it could be your intuition.
It's like our brains working behind the scenes.
Precisely.
Yeah.
And the more we trust that and integrate it with our analysis,
Yeah.
the more effective we can be.
This whole conversation has been so insightful. I feel like we've just peeled back so many layers of this puzzle.
It's been great exploring this with you.
Yeah.
And we haven't even touched on that source about FOMO.
Oh, yeah. The effects of FOMO.
The
PDX.
title's a mouthful.
It is, but I have a feeling it's going to be really relevant.
This research highlights how FOMO is impacting how people invest, especially younger generations.
It's like everyone's trying to get rich quick and nobody wants to be left behind.
Exactly. And social media plays a huge role. We're constantly bombarded with these images of success, lavish lifestyles, easy wins in the market.
It's like it's hijacking our brains.
It is. This research dives into those patterns.
Okay.
One of the most common is overtrading,
Right.
jumping in and out of positions, chasing the latest hot stock, trying to time the market.
Which we know is impossible.
Exactly.
Yep.
And all that buying and selling can lead to higher costs and lower returns.
Right. It's like trying to catch a falling knife.
You're more likely to get cut.
So what's the antidote to FOMO? How do we resist that urge to chase every shiny object?
It all comes back to what we've been talking about.
Okay.
Having a plan,
Right.
sticking to it, being disciplined, focusing on the long term,
Right.
diversifying your portfolio.
So it's about being smart, but also emotionally resilient.
It's exactly. The best investors can control their emotions, make those rational decisions, and stick to their plan.
This has been an incredible deep dive. We've covered so much.
We have.
From the psychology of fear and greed to the impact of technology and even practical strategies for managing our emotions.
And we even touched on intuition.
Yeah, if there's one key takeaway, it's that understanding our own emotions is as important as understanding the market.
I couldn't agree more. By becoming more aware of our biases, developing that discipline and focusing on the long term, we can really improve our chances of reaching our goals.
And maybe even have some fun along the way.
Absolutely. Investing doesn't have to be a constant battle.
Yeah.
It can be a journey of discovery, learning, and growth.
Well said. And on that note, I think it's time to wrap up this deep dive.
Okay.
Thanks for joining us. And remember, the market's unpredictable, but your reactions don't have to be.
Until next time, happy investing.